A record 196 million Americans held credit cards at the end of 2021. That's according to a report by credit data agency TransUnion. In 2022, a record number of new credit card accounts were opened, according to a survey by Equifax. Americans received roughly 11.6 to 11.8 million new bank credit cards through February 2022. And from some internal preliminary data I've looked at after February, it's even more. So that's roughly a 31.4% increase from the previous year. The total limits for these credit cards were $55.5 billion, a 59.2% increase from the previous year. Total credit limits now stand at $4.12 trillion, ladies and gentlemen. That's 224 million billion with a B above pre-pandemic levels. In the third quarter, the latest for which detailed numbers were available, the number of new credit cards issued hit an all-time high of 20.1 million. Some of that 20 million, 9 million of them were to so-called, non-prime borrowers, those with poor or fair credit. So that is concerning. Credit card balances have seen the largest jump in more than 21 years. And when we look at mortgage and auto loan balances also surged. So the bottom line, to cope, with the record inflation, Americans have opened up a record number of credit cards. Data from the Federal Reserve Bank, the good old Federal Reserve, Jerome Powell, Mr. Transitory, released recently revealed that Americans are shielding themselves from inflation by forming an alliance, unfortunately, with the old enemy, credit card debt. As Americans grapple with the highest inflation in 41 years, the number of new credit cards have surged as more Americans, unfortunately, are relying on them to keep up with the high prices right now. And according to a recent report from the Federal Reserve, revolving credit cards, and lines of credits, HELOCs, folks, taking lines of credits on your home, increased by almost 20% from the previous year to 1.13 trillion. So by the numbers, credit card balances grew 38 billion from the second quarter, making up 11% of the overall increase in household debt. That's 351 billion. 351 billion with a B. So just some top line points. Credit card holders between the age of 30 and 59 have balances approaching fourth quarter 2019 levels. Borrowers under the age of 30 have balances now that are above where they were pre-pandemic. And number three, borrowers in the lowest income households have seen their balances surpass pre-pandemic levels as well. So that's concerning. When we look at the delinquency rates, which have remained very low, they're starting to climb among households with lower incomes. So that's kind of the data that I've been following for a year that I saw. They said end of 2022, 2023, you're going to start to see this issue with credit cards. So they are, credit cards are the most prevalent type of debt in the U.S., and credit card balances represent a mix of, people's past debt and new consumption right now. And people are using cards for new consumption more now than ever because of the inflation. And the Federal Reserve Bank of New York's quarterly report on household debt and credit release recently shows credit card balances jumped 16% from the third quarter of 2021. And that's representing an increase not seen in decades, folks. So it's very concerning. The CIIR also found that private label total and average credit lines also reached record highs, as did the average number of, accounts per customer. So when you look at all these verticals, opening accounts, credit lines, credit cards, HELOCs, up across the board. So inflation right now is driving more than half of Generation Z to live with their parents, with U.S. inflation still hovering around, of course they'll say 8 or 9%, but ladies and gentlemen, it's close to 20%. And they said after reaching a 4-decade high in the summer, it's curtailed. Whatever. The increase in credit card balances across the board is perhaps, it's not surprising. It's not surprising, considering everything that's going on right now. So delinquency rates remain historically low, but you are seeing an uptick. As they remain low during the past 2 years with, the pandemic era stimulus, which helped keep that at bay. But now there's an uptick because that stimulus is gone, and then you throw in the inflation and everything else. So the real test, of course, will be to follow whether these borrowers will be able to continue to make payments on their credit cards. The delinquency transition rate for credit cards and auto loans, folks, increased by 0.5 percentage point during the third quarter. The New York Fed found. So similar increases from those of the prior quarter. You're seeing repossessions are up tenfold of cars. Okay, that's not really being reported. You got to know where to look to find that. Vehicle loan balances are up to increasing by $22 billion in the third quarter. Credit card, mortgage, and auto loan balances continue to increase in the third quarter of 2022. So it's reflecting a combination of robust consumer demand and higher prices. However, new mortgage originations, of course, have slowed to pre-pandemic levels and rising interest rates. So that's a given. So meanwhile, right now, the high inflation and high interest rates are making it harder than ever to pay down that credit card debt right now. And you're seeing a lot of people are opening up these cards, and the research I did, they have 0% through all of 2022. And then they kick in 16 to 20% in 2023. These banks are very slick. They follow the trends. So not only are credit card balances back to pre-pandemic levels, but consumers are also carrying balances for longer periods right now. So among Americans who carry credit card debt from month to month, 60% have been in credit card debt for at least a year. And this is not me just saying this. That's from creditcards.com. So as the Federal Reserve, the transitory institution, raises its target federal funds rate, so they raise the federal funds rate, credit card annual percentage rates are climbing as well right now, and at a frightening pace. So, I'll end with this, kind of just put a bow on this. In the last 2.5 years, driven by the so-called pandemic and a regional war, a new macroeconomic paradigm is forming. So you have the high inflation is back after a 30-plus year absence. And with it, much tighter monetary policy. Interest rates are rising. Central banks around the world are burning money. The era of plentiful dollars is coming to an end, and that will mean persistently lower prices for cryptocurrencies. What's going on there with FTX? Crypto markets have never known anything but easy money. Bitcoin was born, in the aftermath of 2008, financial crisis, when, many people feared the central banks, and, the central bank experiment with ultra low interest rates and quantitative easing since 2008 would cause, runaway inflation. People were worried about that early on, and Bitcoin came from that. 10 years later, interest rates were still far below, pre-financial crisis levels, and the central bank balance sheets were still massively inflated if you look between the lines. And the runaway inflation predicted by Bitcoiners had failed to appear because they just kept printing and keeping those rates low. Instead, asset prices had risen massively, including cryptocurrency prices, as investors were desperate for yield, wanted some returns, and they piled it into Bitcoin and other cryptocurrencies. So I got calls on FTX, and I'm not a complete expert, but I'm still buying Bitcoin, and I understand blockchain. I understand coding. I code, and I was like, no, I'm not going to buy centralized. I've always bought decentralized. I still buy Bitcoin. I bought it up to almost 50, and I bought it at 12. I buy it every week. And I know people that lost their ass in this, and not just low-level retail investors. Take a guy like Scaramucci, Anthony Scaramucci. The guy's, whatever. He's got a fund, he says. I saw this guy at the Polo Lounge one time. He had a G-Wagon with 24-inch tires on it. He's a real short guy. He's like, well, he's got a complex. But he lost over $40 million. He flew out to the Bahamas to meet with this kid, and he got taken to the cleaners with his funny hair and his shorts and his beanbag. Anthony, you wear nice suits. Come on, never trust a guy with hair like that. So guys like that lost money. It's crazy right now. So what's going on with the crypto implosion? I mean, you just look at little micro things. For example, I have a friend in Miami who owns a condo there, and he works in the nightclub business. He called me and said, we are down big time, tenfold, Tim, because a lot of the patrons that went to the nightclubs in Miami paid with crypto. They paid with crypto, and now that business is crashing. So you have to factor all that in. The crypto, a lot of people were using crypto money to throw it out and even buy properties. It's dried up. The FTX has caused a massive pain in the markets. So you're looking at all that. It's just piling on. And you see the crypto crash, the interest rates, the inflation. So you can understand this credit card situation. And it's very concerning. So the data that I looked at a year ago, so this was going to happen in 2022, 2023. These credit card companies are slick. They're offering 0% right now all through 2023. And then it kicks in at 16 to 17%. From the research I did, they started doing this in 2022. So like I said, in March 2022, I'm seeing an uptick even after March to now to 2023 of massive amounts of credit cards being opened up. So like I said, you not only had retail investors take a hit, you had multimillionaires take a hit off this FTX thing and other things going on in the market. So it's the billionaires that are going to clean up with what they're trying to do right now. So it's interesting, epic times to be alive, but we'll have to keep an eye on the credit card situation. It is very concerning, the amount of credit cards that have been opened up in the last year. Take care.